Welcome to this session of Accounting for Decision Making. It's first time MBA of Anna University. Unit 1 Financial Accounting. In the Financial Accounting, we are learning the Introduction to Financial Accounting. Of that, so many I think 5 videos have already been posted. And in this video, we are going to learn about the principles of bookkeeping. Now let us study about the principles of double entry system. Double entry system was first introduced by Luca Pacioli of Italy in the year 1494. According to this system, every transaction is divided into two aspects. One aspect of the transaction is called debit aspect and another aspect of the transaction is called credit aspect. Hence, every transaction will be recorded in two accounts. For example, a transaction wages paid for rupees 70,000 should be divided and recorded into two accounts, namely wage account and cash account. Since every transaction has debit aspect and credit aspect, total debit transactions will be equal to the total credit transactions of an accounting period. Hence, double entry system may be defined as a system of accounting in which the transactions are divided into debit aspect and credit aspect and recorded into two different accounts. Now let us study about the meaning of debit and credit. Where debit is derived from the Latin word debitum, which means due for that. The word credit is derived from the Latin word credere, which means due to that. Rules of double entry system. The accounts are classified into three categories for the purpose of the writing journal and ledger accounts. First one personal account, then real account, and third one nominal account. For the convenience of writing the two aspects of the accounting transactions. Let us see the rules of debit and credit for these three accounts. First one, personal account. Debit the receiver and credit the giver. Real account. Debit what comes in and credit what goes out. Personal account. Debit the expenses and losses and credit the income and gains. Now let us study in details about these three accounts. First one, personal account. Personal account records transactions connected with a person or firm, that is natural person and artificial person. A person or firm may buy or sell goods from the business, receive or pay loan to the business unit. Hence, a person may either be a giver or receiver. Only persons connected with any accounting transaction will be considered as personal account or taken to the personal account. If he is a giver, his account is credited. For example, if X sold goods for rupees 90,000 to a business, X is called the creditor and X account is credited. That is, he is a giver. If a person is a receiver, his account is debited. For example, if Y purchased goods for rupees 30,000 from a business unit, Y is called the debtor, that is receiver, and Y's account is debited. Hence, the rule for the personal account is debit the receiver and credit the giver. Second one, real account. Real account is an account for recording the real thing, otherwise called assets. Assets may either come into the business or goes out of the business. When assets come into the business, the asset account is debited, that is inflow of assets. When assets go out of the business, the asset account is credited. Hence, the rule of real account is debit what comes in and credit what goes out. Asset comes in means inflow of asset, and assets go out means outflow of the assets. Then third one, nominal account. The account which records transactions like income, expenses, profit and losses is called nominal account. Income and profit are credited and expenses and losses are debited. For example, salary paid rupees 75,000 is debited in salary account, and commission received for rupees 39,000 is credited in commission account. This is since it is a income. Hence, the rule for nominal account is debit the expenses and losses and credit the income and gain.